Good morning and welcome to the CQS Natural Resources Growth and Income PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Robert Crayford, Fund Manager. Good morning, sir.
Hi, thank you very much, and thank you everyone for listening in today. We appreciate there's different levels of understanding on the fund, so apologies because we're going to kind of touch over some of the more basic aspects as well initially, but we'll also provide some thoughts just around our sort of thinkings on our thoughts on the market, and leave plenty of time for Q&A at the end, and then we can really hopefully answer any questions people might have. But just to summarise, Keith and I co-manage on three resources-focused investment trusts. So we have CQS Natural Resources, we have Golden Prospect, and Geiger Counter as well. And there's definitely a bit of overlap and information exchange across those holdings. The funds themselves, they are within CQS. So CQS is about a $16 billion asset manager, and they are owned by Manulife, who's much larger, with about $1.5 trillion in assets. And I won't dwell on that overly, but here we have a bit of a snapshot of the fund. Key things to take away here is sort of healthy dividend yield of 3.4%. That will be changing on the recently announced tender offer, where the dividend will be increasing to 8%, paid quarterly, based on the prior quarter's NAV. Sorry, just 1 second. We get a bit of feedback. Thank you. So the dividend yield will be going up, and the fee will be reduced to 1% per annum as well. The other things to kind of point to is a relatively concentrated top 10, as you can see there, 44.2%. So fairly high conviction, but there is a larger number of holdings. But one thing we would flag with that is, whilst we have a fairly concentrated sort of top of the portfolio, there is a tail there of things like some warrants, etc., that can be received within equity placement. So actually, that suggests, that kind of makes it look like there's more holdings than there really is in reality. And sometimes there's double counting where you hold the same company on two lines, depending whether a North American line or an Australian line, etc. Other thing I point to is the allocation. So currently very large weighting towards precious metals, and we'll talk through that in a bit more detail. Basically, we really like the top-down and bottom-up aspects to that sector currently. I'll touch on some of the other weightings, but that's certainly a lower oil and gas weighting than we've had historically, and the lowest copper weighting we've had in recent history. So moving on, as we touched on the other funds that we also run, and we work with Ian Francis, better known as Franco, who runs the New City High Yield Trust as well. Quick one on performance. We used to have a benchmark, but it was discontinued. So now we just use as a reference point. We provide the MSCI World Metals and Mining and MSCI World Energy. This fund is very much actively managed, which I'll touch on in a second. But ultimately, our aim here is to try and outperform both of those indices by allocating to the most attractive over the long term. Now, there will be fluctuations. As we know, markets aren't entirely efficient. But over the long term, as you can see, there's been a strong performance, relative performance versus these underlying indices, and that does continue to prior to that as well. Clearly, there's a bit of noise here as we're kind of this five-year period starts to include that kind of early COVID disruption period as well. Key themes. So we put this in basically because we're very constructive on the sector over the long term, and we think there's some real key themes here that are ultimately multi-decade themes that we believe really tie into commodity demand and commodity supply. So there's been an extended period of underinvestment. This the focus on ESG has ultimately constrained supply, and we've seen that from the largest producers down to lower tier, as well as getting financing. It makes it more difficult to bring new projects on, and the energy transition itself, which there are sub-cycles to, as well as the longer term cycle, but ultimately the energy transition is happening and will increase demand for commodities overall. We touched on it earlier around the sort of, well, basically this fund is unashamedly actively managed, and we think this is a key differentiator and well suited towards the investment trust structure. So it's a clear differentiator versus ETFs. It's a clear differentiator versus a lot of other resources focused open-ended funds. It allows us to focus on names that we see the best value opportunity, rather than just allocating based on liquidity. And as you can see on that bottom chart, we've broken out there how we've been exposed to energy, precious metals, base metals, and other over that period. So, just for a bit of clarity, you can see we increased the energy weighting in that post-COVID period, in part due to them being heavily beaten up on a weaker energy prices, and ultimately led to stronger returns. And then we've heavily rotated that back, sold that down, quite cautious on, particularly on the oil outlook, but we'll touch on that a bit later, with far more conviction around the precious metal weighting currently. And as you can see, back in that kind of 2020 period and going prior to that, we used to have a larger base metal weighting, which we've very much intentionally decreased given our concerns and cautions around Chinese growth and the property sector, which we can go into in more detail. So yeah, the main takeaway is very heavy weighting towards precious metals. We think the miners themselves are very attractively positioned here. Fairly diverse regional split. This can vary depending where we see the best risk reward and value opportunities. Top 10, I won't kind of go through it line by line, but we often refer to the fund as being kind of small mid cap. I think it's just important to clarify that that's kind of small mid cap on a global scale, because sometimes small cap in the UK can suggest people or suggest an allocation towards micro caps on a global scale. So we really see that sweet spot in where we focus on around that sort of 200-300 million market cap up to around 2 to 3 billion. And this is because as you kind of transition up market cap, hopefully through operational improvements, that you get greater index inclusion, that leads to higher earnings multiples, and we believe can drive incremental alpha over the underlying sector performance. But as you can see, fairly large weighting in the conviction positions towards precious metals, which we do think look attractive going forward. So why do we like the precious metal sector so much? So one of the most attractive aspects is ultimately the valuations. Gold price has rallied very strongly over the last 12-18 months, and despite an upward move in the miners themselves, generally the sector has moved on around about a 1-to-1 kind of relationship. What you would expect is to see more operating leverage from the underlying performance of these miners in valuation terms, because as gold price moves, say from 2,000 to 3,000, if you've got a $1,000 margin or $1,000 production cost, then effectively your margin is doubling. So you'd expect to move more than the 50% move up in gold price. And so far we just haven't really seen that come to fruition. And this has led to the valuations on the miners themselves trading at some of the lowest multiples we've ever seen in history, both on a price to MPB basis, which we're showing here, versus spot, and a 10% discount rate. But similarly, if you look at it on a PE basis, the sector overall is trading around mid-high single digits as well. We think this creates a very compelling argument for the precious metal sector and the miners themselves, and we expect to see a degree of catch up in the miners as higher earnings feeds through both into earnings, into higher dividends and buybacks. Although so far that activity being relatively muted. So the mid-tiers and the larger cap companies are seeing, which already have strong balance sheets, are seeing increasing cash piles on their balance sheets. And we expect to see a further step up. And we have seen a pickup in M&A, but we expect to see a further pickup in M&A going forward, where we think our names, with one or two assets, and our focus on meaningful scale assets really would appeal to those mid-tiers looking to effectively spend that capital, look to grow, and ultimately try and achieve higher multiples. One thing we have seen across a number of our names has been kind of lower premium takeouts or mergers, which has allowed them to ultimately achieve higher multiples through consolidation, basically through through greater index inclusion, more ETF purchasing, and greater appeal to generalists who generally need larger market caps. Moving on to the next slide. The valuations are attractive, but we also think that the outlook for precious metals is also very attractive. So coming into the recent turmoil that we've seen coming out of the US, what we can see is that central bank demand has been the primary driver of the strong gold price. And this really shifted post the Russian invasion of Ukraine, where central banks prioritized buying gold over US treasuries after the US effectively weaponized US treasuries versus Russia. And that has basically made gold a preferable asset to hold within central bank reserves, given it isn't under the influence of any foreign government. What we've seen more recently is the US-led trade war, which is only going to further increase central bank support for buying gold and using that as a reserve. So we expect to see more central bank demand coming through. Another driving factor has been bar and coin retail demand, primarily in emerging markets, where they've been doing this or the focus here has been to try and protect their wealth relative to depreciating domestic currency. And this trade war fallout is only exacerbating those concerns. So we expect to see continued strong central bank demand and bar and coin retail, but so far we've seen very little participation by financial players, and by this I mean kind of more kind of generous funds owning physical. And we have this top chart here showing physical gold ETF holdings, which had been steadily selling down for the last 5 years before we saw a more recent increase in the last 3 to 4 months, although that's kind of plateaued and actually turned negative again through May. So our expectation is that we will see a greater return from financial player participation in the gold market, both in physical, which we expect to show up both through ETFs and physical in warehouse, but also in equities, where we really haven't seen a lot of generous participation in the gold mining equity ownership as well. And that's been evident in some of the major gold ETFs, such as the VanEck Gold Miners ETF, which is one of the largest gold mining ETFs, which has seen its share count collapsing into this more recent rally. So that tells us a real potential catch-up trade as we see a rotation or an anticipated rotation from generalists back into the sector, given improved earnings, higher buybacks, dividend, and more M&A going forward. So we really like the top down, we really like the bottom up, and when those things align, then it allows us to have a far more concentrated position in the underlying commodity. And with that, I'll pass this on to Keith.
Thanks, Rob. Yes, I think that was a very well put across point, that really we try and invest through cycles, some of which are longer than others. I think when we look at that, we also look at key themes, and we put that up there with fossil fuels. I would say, though, that I wouldn't overemphasize that at the moment. As Rob outlined, it was a much, much bigger emphasis post the COVID recovery and the Russian invasion of Ukraine. But for the time being, I think I would outline that the demand for oil is growing, but just at a slower pace at the moment. Basically, we do see a situation where we've got a a slight slowing in global growth outlook, accompanied by inflation, which may actually raise up some of the stagflationary risks that play better into the hands of the likes of gold. On this slide, though, the one area, certainly in terms of thematic, that I would like to highlight is currently uranium. Certainly, if you've been listening to the news today, you will note that there's a lot more government funding going into that sector at the moment because it fits so many of the bills in terms of delivering energy, electricity primarily as part of the transition without as many emissions. And that is a complete transformation over the last few years that we've seen from a previously shunned industry. And it brings us back to a point that Rob made earlier, which is we look for sectors where there are the most imbalances. And coming back to uranium, I'll touch on it in more detail. There is a huge one there. When we look at the fossil fuel element of it, though, it has reduced. We do now have something like 14% in the E&P sector that is predominantly weighted to gas, where we feel that there is a more, there'll be the balancing item in terms of the transition over oil or coal particularly. There was a point back actually around COP26 when all fossil fuels were so heavily criminalized by authorities that we took a reasonable position in what were good, well-managed coal assets, and they doubled and doubled again. And that gives you a flavor for the potential that you can sometimes see on when you are able to invest through cycles. Gas at the moment, though, is probably something like 10%, and it's directed at sort of the lower cost producers that we see there. We look at shipping. Again, there's another slide later in this, which I'll come back to, but essentially that is a thematic that is based on the same supply versus demand dynamics. I don't really want to labour that at the moment, just suffice to say that if I refer back to slide 9, the oil and gas weighting is lower than it has been previously because I think one of the biggest factors is currently on the supply side. We felt that OPEC was likely to turn the taps back on, and we are now seeing them shift back to a market share over price focus, and that for the time being, in the context of where we can alternatively allocate funds, just means that that sector moves to the background for the time being. We'll see there can be volatility with regard to sanctions being applied or removed, or just general headlines, because who knows what Trump might say from one day to the next. I would outline that we also, in the context of shipping, look at other service providers. We do like the opportunity that seems to present itself in terms of the valuations for the offshore drill rig companies such as Transocean. Certainly that's one that lends itself to the increasing activity that we're likely to see off the Ghanaian coast, but also West African coast is another potential destination for those. And so we're keeping an eye on that, but for the time being, it's not such a big exposure as it has been previously. If I flip forward a slide, this really just brings out one of the earlier points I discussed, which is the lack of investment that we've seen since Fukushima in 2011 is such that the production of uranium, the yellow solid chart there, falls short of the demand outlook, and that's the green line, and is only projected to widen as we get towards the end of this decade, as many mines are actually depleting, and there has been such underinvestment that we're looking for the next projects that will fill that gap. I've outlined already the basic benefits of nuclear, zero carbon, significant government support. So in that sense, it's slightly more removed in terms of financial availability to fund development projects, because we're seeing some of that government support, whether it be in the UK, which frankly in a global context is irrelevant, or more importantly in the likes of the US, where we've seen them extend reactor lives and are now firmly committing to open another 10 by the end of, or at least start construction on a further 10 by the end of this decade. China, meanwhile, has just continued to roll this out. It clearly sees the benefits of all of this and actually has been very active in terms of its development program, and it's the leading driver of that demand growth up to the end of this decade, by which time it will probably supersede the US as the largest single nuclear power nation. And it's currently, if we look back at the recent news, able to develop standardized projects based on either 1.2 or 1.4 gigawatt large-scale reactors at around a fifth or a sixth of the costs that are currently sort of experienced in the likes of the UK and even in the US. And they are just pressing on very hard in that sector. We look at companies like NextGen. You'd have seen that that was one of the top 10 holdings. And the reason that we like that one in particular is that it's been developing its Rook 1 asset, one of the highest grade projects globally, actually in any commodity. If you were to put it into gold as an equivalence, it would be something like 1.5 ounces per ton of gold in that reserve. If you were to put it in copper, it would be around 50% copper. And, you know, to an extent, we will look through the actual commodity itself when we see those sort of economics. And for NextGen, that is of global strategic significance. Likely as not, it will be folded into one of the larger producers, or maybe even another energy producing nation that wants to have some influence over the global energy markets, because it is that significant. And it trades at a substantial discount, again, a theme that Rob has outlined previously, to the typical industry leaders that you would see, like Cameco, which at spot trades at around 2 times NAV. NextGen currently trades below NAV at spot, and won't have much difficulty in terms of finding funding, and is fully exposed to the upside in the uranium price because it's not contracted forward at on any of the funny structures that are often put in place by the likes of Cameco. So bear with that sector. Don't necessarily get sucked into the whipsawing that can take place. It has real legs for a decade worth of recovery. If I jog forward another slide, you know, this really does, I think, just outline another cycle within the energy transition that Rob and I have played. In this case, it's lithium. The green line that you see on the chart there is the lithium price, and that's in comparison to the copper price, which is ultimately the delivery of most forms of electricity. And we had a very substantial bubble arise in that sector. Just for reference, Rob had scoured around for looking, and myself, for, you know, the most interesting lithium projects. We actually settled on the fact that we preferred the hard rock, the higher grade hard rock providers, rather than the big working capital environmental brine evaporation ponds. And ultimately we invested in a company called Sigma back at, I think it was 2019. We saw a huge run up in the lithium price, with a lot of stimulus coming out of governments directed at, you know, headline grabbing EVs. But we felt that then drove the lithium price too high, and there was a wall of new supply coming on, as a result of which we largely sold out of Sigma. We still actually retain a very small position in it, but, you know, that went from a sub $2 to something up to about 50, and we timed that particularly well. But the main point of this slide is to just show that there are some short cycles within the commodities markets that you can really take advantage of. As it happens now, we'd be tempted to look back at this sector because some of the valuations are starting to screen out as potentially attractive again. But the consumer is probably the impediment to that sort of timing at the moment, because EVs are, yes, gaining penetration more generally among the vehicle market, but, you know, we don't think that it's such an easy sales backdrop at the moment. For choice, we would still probably prefer copper, which I will move on to on the next slide when we discuss base metals. It is one of the more economic metals, given its conductivity. The price has been relatively stable, but I would note that in the current macro backdrop, we don't really see such opportunities we do in, say, the gold sector or the uranium sector for this, but the longer term fundamentals we absolutely like. If we look at the reasons behind our slightly more cautious view on base metals and actually ferrous metals at the moment, the best chart that we find and most helpful for investors is the one on the bottom left there. And the orange line shows you Chinese housing starts pushed out roughly 2.5 years, which is effectively the time it takes to start construction to final completion and fit out. And the fact is that we've got housing starts which have fallen off a cliff in China, and the trends are struggling to really try and improve. We've still got huge, something like 80% decline in new starts that we've seen, more recently. And for that reason, we don't own any iron ore because that's one of the fundamental metals that goes into construction of property. Rebar prices are low and still trending down, and we've also got some new supply coming on stream with the likes of Simandou in West Africa. The important point when it comes to copper is that that is used in the final fit-out stage, whether it be for wiring or air conditioning. Air conditioning actually in China is responsible for something like 20 to 25% of its domestic copper consumption. And for that reason, with the outlook still fairly muted and the valuation of stocks in contrast with the likes of the gold producers still relatively optimistic about the outlook for copper, we just don't see the same level of demand. And for that reason, base metals at 5% is as low as it's ever been. That's the most helpful factor. But, and I think this comes back to another point that I would like to make using this slide, when we look at phases of development, we do like developers in the copper space. At the moment, I would say that broadly, any mine that requires funding is probably weighed down in terms of sentiment by investors. In the case of gold and to a degree copper as well, the developers are almost frozen out of investable horizons for many of the generalists. And we find projects there that might fit better into the sort of outlook in 5 years' time than we do the actual producers. And for that reason, we do, within that 5%, look at some of the better projects that we think will fold into the larger mining companies as M&A picks up, as it likely will because of the lack of greenfield investment and exploration that's gone on. And that is an area of focus. I would say, just as a side note, that there have been periods, and certainly back prior to COVID, there was a period when the mining industry was struggling across the board. And at that stage, we had a much higher exposure to developers over producers, and they would have been the dominant percentage holdings in the top 10 even back then, along with some of the energy suppliers if we looked more recently. That's really the point that I would like to make on that slide. I would note, though, that iron ore you can probably own more cheaply your own in any event than perhaps relying on us to roll up our sleeves and sift through the hundreds of companies that we're able to that are off the mainstream investor focus. And that is the advantage that Rob and we think, bring to this closed-end structure, and that we can sift through all of those opportunities for investors and just alight on the best ones. And at the moment, that happens as a sector to be those thematics that we've pulled out in preference to those that we just think have taken a bit of a back seat at the moment. But by rotating through cycles like that, our aim is to try and maintain some positive total returns through cycles, full stop. If it's bad for base metals, it's probably good for gold. If I jogged on one more slide, this really is just going through a little bit more background on the reasons why. Certainly latterly we've been even bigger in shipping than we were currently, and it was this same supply side issue. No financing was available to build ships. The propulsion regulations were moving in the ESG direction, and no one wanted to invest in ships for that reason. And as a result, the order book was low, ships were going to be retired, and also ultimately that means limited capacity to ship goods. We were looking primarily at energy shipping, so that's very large crude carriers or LPG carriers, and they were trading at a big discount to NAVs at the time. Those have subsequently corrected a little bit to sort of more cash flow based valuations, but for the time being, we've seen a little bit of a blip up in some of the replacement values coming on, but for choice, if we look back at shipping, or when we look a little bit more meaningfully at shipping, we'll be looking for those that have got the best in class, such as Frontline, which recently acquired Euronav, that was one of our big shipping holdings. If I jog forward to the next slide, I think this is just something that we would highlight, in that we hope that investors will see the opportunity that Rob and I can bring to, I think, ultimately real assets, which in the current environment we suspect in an unencumbered fashion are a very useful portfolio diversification mechanism, rather than just following the momentum style of investment that's been the case for a number of years globally, particularly in the Western markets. Gold at the moment is certainly the biggest exposure that we like as a result of the current environment. ESG is still limiting supply broadly, and just be aware that we will look to get back into some of those base metals when the opportunity arises, and it will be a rotation out of the likes of gold. And again, I would just highlight on this slide the bullet point that we don't really own BHP, Rio, or the BPs, the large cap liquid plays. One, because they're generally on higher valuations, and two, you can just own those on a much cheaper cost ratio by buying them direct yourself on the market. And we do like, the environmental focus. We do go for best-in-class management teams, which incorporate that type of mechanism into their overall management process. And we have traded at a discount, and that's closed in recently. But we still think there's a long way for this broader sector, and particularly with our focus, for the NAV to move forward. And with that, at 32 minutes past, I think we can open it up to questions.
Yeah, Keith, perfect. That'd be great. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right-hand corner of your screen. We have received a number of questions, both pre-submitted and throughout today's live presentation, and I'll start with the first one here, which reads as follows. With a tender offering taking up to 60% of the shares, this will result in a much smaller trust. Is the board looking for a merger partner? Would a trust like BlackRock Energy and Resources Income Trust be a good option?
I'll turn off mute. That might help. Yeah, I'm happy to take that one. Yeah, so the tender's been announced. We don't know how many shareholders will tender. What we do know is Saba, with a 29.9%, have agreed to tender. So that would certainly reduce assets by 29.9%, but we certainly wouldn't expect it to be as high as that 60% stated there. The board did hold a strategic review, and it was very clear that they've looked at all options that are open to them. And it was their decision that to go through this tender process, to reduce the fee to 1%, and to go to an 8% dividend was the best outcome. And that's why they've selected that. So, I mean, as far as mergers, I think this is a board question, but I think it's fair to say that they've looked at all options that were out there. One thing I would say, if any of the other potential merger options, the strategies are very different. As we've said, this is very much actively managed. If you look to a lot of the sort of the other funds that are out there, they focus on very much different equities, so it's quite a different strategy. Also the performance of this fund has been stronger. So I think that, and with the very strong shareholder vote that we had around the Saba approach, I think there was a fair, clear sign that shareholders wanted to continue with this strategy rather than change that. And yeah, so I don't think there is a need. Personally, I don't think there's a need to look at kind of particularly changing the structure or looking to mergers. I think it's is entirely manageable even on a slightly reduced AUM.
That's great. Thank you very much, Rob. We have another question here. I note the directors' intention not to tender their shares in the tender offer, but their individual holdings are not significant. What are the combined holdings of the managers and their CQS colleagues, and what proportion do they intend to tender?
I'm happy to jump in on that one. I mean, I can't speak for everyone's shareholdings on what's not disclosed, but I can speak to my own. So I have somewhere around 70,000 shares. So it's a very meaningful part of my liquid savings. And yeah, I'm certainly not going to tender any. Firstly, it wouldn't make sense because, well, I can't give any advice or anything, but clearly the discount is now at a level, I think, sort of 6% or so. This is money that no people aren't going to receive for 3 months. There is the tendering cost is borne by anyone who tenders, primarily SABA, and also the amount that's received is kind of unclear. So any kind of a liquid names in that within that portion would ultimately need to be sold at the end of that 3-month period, and there's no certainty of what would ultimately be received. So yeah, I don't think it makes sense. I'm very encouraged by the future outlook for this fund. I think it's very unique in its ability to get exposure to the underlying to differing sectors, and rather than just really focusing on one strategy and kind of replicating an ETF. So I'm very excited for the future, and I certainly don't think it would make sense for anyone to tender here.
I would echo that entirely. There's no chance that we'll be tendering any of our shareholdings.
Perfect, thank you. The next question's really around the dividend. The Trust's 8% dividend seems high given recent returns, especially since the strong 5-year performance that was boosted by the COVID rebound. If returns are lower going forward, won't the Trust need to sell assets just to keep paying the dividend? And what is being done to make sure the dividend is sustainable and doesn't erode the Trust's capital over time?
And sorry, I'm going to jump in on this one as well, because I saw that one while Keith was talking earlier, and then I pulled up the numbers. So yes, I appreciate COVID does make the data look noisy. So I ran that to 6 years, so to June 2019, so obviously pre-COVID period, and the fund NAV has returned it's about 18% per year. Yes, so the dividend level will be lower than the return we've seen. Obviously, past performance is no indication of future performance, so I do understand the sort of inference that's being made here. But yes, 8% clearly is a high dividend, and that's something that is appealing to a bulk of UK shareholders, and that was certainly the view taken by the board, that is attractive and to the majority of shareholders. And I appreciate it won't appeal to every single shareholder, but to the majority of shareholders, that was the view was that would be seen favourably. Now, as far as actually paying out the dividends, the fund some years ago, very much at our Keith and I's request, shifted the board shifted the mandate from paying out of income and allowed for dividends to be paid from capital. So that really unshackled us effectively from having to chase high yielding equities or bonds to pay what was a very burdensome dividend back at that point when Keith and I took management in October 2015, and allowed us then to focus on a more total return approach. So, this is very much the view taken by the board, that if we can continue with the exact same total return approach that we are currently conducting on the fund, so there'll be no change in strategy. And being commodities, it is very cyclical. There's been periods where we've had very high dividend yields for some of our names, and there's been periods where dividend yields have been far lower. But we don't want to be restricted in having to chase dividend yields, because often it will mean that you're allocating to sectors often at the top. So very much that isn't going to be the focus of the strategy of the fund going forward. And we do believe that dividend is payable from both income and capital return. Now, that said, there may be periods where you get much higher income, and we've seen that in the likes of shipping, where some of our shipping names were paying as high as 30% dividend yields, but we don't want to be having to chase that. So that is, I just want to make it very clear, that isn't going to be part of the strategy in trying to meet this. This same total return focus is going to continue.
Thank you, that's clear, Rob. I think you have covered this, but if there's anything else to add, please do. How will the tender offer impact the structure of the company going forward? Will the reduced size impact the investment strategy?
The tender offer, there's a vote due on the 25th of this month, which will determine the proportion of investors that choose to take their money out of the fund and go into effectively the wind-up pool. Saba have intend to tender all of their current shareholding, and we'll see what extent any others follow suit. It will, as Rob outlined earlier, basically then go into a runoff. We'll sell down those shares and distribute the proceeds back to those in that vehicle. With regards to the underlying investment approach in the continuing vehicle, we don't think it will have any impact whatsoever. We find it hopefully it will remove a disruptive factor in the background. We just like to have all of our time focused in on a fund which will have a lower management fee, and it will have the higher dividend yield, as we've just discussed there. In terms of everything else, we still feel that the closed-end structure has those advantages, and we just want to continue to actually quite the reverse of putting up with investors. Actually, we really want to grow it.
Thank you very much, Keith. The next question here: how long will the standstill agreement with Saba remain in place?
That will remain in place, I think, until an AGM in 2028. So it will be a 3-year standstill.
Thanks very much. Just changing gears slightly, do you have an interest in silver, and will you look to play this in the coming months?
We do like silver. I'd say if we look at its ratio to gold first as a subjective measure, it's towards the top end of its last decade sort of ratio, so that screens it out as a potential investment. To be fair, though, if you benchmark most things against gold at the moment, they all look pretty good. What would be different in silver is that 80% of its production is from byproduct, and that means that ideally we would like to see a little bit more of a supply correction from these polymetallic mines that still seem to be able to produce, because the copper price, for example, is holding up reasonably well, or the lead and the zinc prices are holding up reasonably well in the current context. So from a supply side, we don't quite see the timing as being ideal to move in that. From the demand side, we've got some 50% of being industrial related, and that for a moment is also something that might just be keeping a little bit of a lid on it. But it's certainly something that is at the forefront.
Sorry, Keith, I think we have momentarily lost you. I'm just going to...
Keith, your headset seems to have stopped working, so we'll just try.
What I'll do, Keith, is I'll just refresh your browser and bring you back through.
Okay, I mean, I can just finish up on silver. Yeah, we do have exposure. It's around a bit under 5% of the fund. Yes, we think it's attractive. There's clearly uncertainty just around the industrial side being over 50% industrial led now, but it does tie into some very key sort of growth thematics through, EVs, wind power, arguably through data centers for AI, etc. So there's some long-term demand thematics, and more recently in the last week or so, we've definitely started to see a bit of a bid coming back from some like more retail buying as well. So that certainly helped push things higher. Thank you.
Perfect. Another question here around gold. How do you see the holding of physical gold impacting the gold price?
So I'm not entirely sure I understand the question, but what I think it's asking is if we see, I think this is in relation to the physical ETFs. So if we continue to see, as I laid out earlier, strong central bank and strong retail demand for bar and coin, if we then see a return to buying from financial players through the physical gold ETFs, then that would likely send gold higher, because ultimately, when we look at gold, it's very difficult to kind of analyze it on the price and the supply demand aspect, but the way we look at it is more from a a flow perspective. So, who are the sellers, who are the buyers, where is the incremental flow, and ultimately where does that point directionally gold is heading for that to balance.
Perfect. Thank you very much. How do the underlying commodity prices impact your reinvestment strategy?
What I say is we're very fluid in how we do it. So a low commodity price doesn't mean you wouldn't buy it. Actually, it can mean the opposite. So it can mean that is the time that you want to get involved, because inherently we're kind of drawn to things that are a bit more counter-cyclical and contrarian. So that's kind of more within our style. The trust itself allows us to kind of be more long-term focused. So we'd rather buy things that are at discounted levels. When we look at commodity prices, we have to look at it on a sector view overall. So, if you're deep into a cost curve, i.e. a number of producers are losing money, then you can have greater conviction that you're somewhere near the bottom of a trading range for that commodity price. And often that correlates with the mining companies that relate to that commodity, or energy companies, having traded down against the weak commodity price. And if we have a conviction that there will be a bit more rationalization around the supply of that commodity, i.e., those losing money end up cutting supply, then we can have a bit more conviction and kind of allocate to that. Arguably something like lithium now is starting to fall into that that realm. But then similarly, prices can be high. And then in the case of the gold companies now, so gold price is high, companies are generating strong returns, but actually the stocks are very cheap relative to that, because the market clearly doesn't either believe the gold price is sustainable or the costs are sustainable from those companies. So it's very fluid. It's the kind of top down versus bottom up. And if both align, we have a larger weighting. If we don't like either, we have a very low weighting. And if it's somewhere in between, then kind of weight accordingly.
And I think we also have to view, how does it affect the outlook for the corporates? I'd say if we looked at gold in particular, clearly relevant for the fund overall at the moment, there has been a huge reluctance for the large cap miners to conduct M&A. There has been a little bit of some combinations coming through, but the valuations are still very high. Where we've noticed it more is in the sort of market cap size that we've invested in, where there's been more sort of acquisition activity taking place. So, things like Calibre have been taken over by Equinox, and that type of, and that's really helped drive some of the performance that we've seen in the holdings in the fund.
Perfect. Thank you very much. The next question here, do you have an outlook on the ability of uranium supply coming on stream to keep pace with this accelerating demand? Where will this come from?
At the moment, there is a yawning gap that no one seems to know where the uranium will come from, to the extent that, once you move beyond the likes of NextGen and the phase 2 extension, assuming that goes ahead, which I'm sure it will, with the likes of Cameco's Cigar Lake, that will extend its life beyond 2036. Even that will only maintain production, though, from Cameco. We need new production to come out of pretty much everywhere. I mean, it's a 50 million plus shortfall and widening on even the less optimistic demand growth scenarios that we're talking about. The crucial thing, though, to remember about the uranium, particularly, though, is that in such an event that there is a sustained shortfall, as we expect, uranium, even at $100, is only something like 8% of the value of a kilowatt hour of electricity. So it can double and double again before it starts to make a meaningful dent into the consumer electricity prices or the industrial cost of electricity. And that's one of the key reasons that we really like investing in the uranium miners, as opposed to even to an extent the service providers, which will benefit as well. But we want to see the likes of NextGen being brought into production that is a scalable project, and I think it will be able to influence the price that is received by that company, because it can price it at $1 below the next cab off the rank, and there aren't that many of any meaningful scale. The only one of significance would probably be Olympic Dam Phase 2 expansion. That currently produces something 5 or 6 million pounds of uranium a year. So that's about 2 or 3% of global raw yellowcake supply. Mines in Namibia are getting trickier because, the government now has fallen out with certainly the French influence. And, Orano is going to be one of those companies back on the M&A theme that will be looking to replace its lost production in that sense. But M&A does not add greenfield production. We'd like to think that companies such as ISO Energy, which has got one of the highest grade uranium deposit, which is actually abutting a tenement that's owned by Cameco, will be brought into that fold and brought online. Certainly, it's a very clear opportunity. And then very quickly, you're getting down into single-digit millions of pounds a year for new supply coming on stream. That's the benefit of investing in that sector, which has received no attention for over a decade, nearly a decade and a half.
Thank you very much, Keith. Another question here. Given the accelerating energy transition from oil and gas, what do you think will happen to demand for support service providers?
Can I jump in on that one? Yeah, so the energy transition accelerating away from oil and gas. So the way we would frame that is actually oil demand is still marginally growing. So it's not like oil demand is collapsing. We have now had a view into what kind of peak oil looks like within countries. So specifically in China, now they're kind of trending towards population decline, and EV sales are such a large proportion of new vehicle sales, as well as kind of leading the way on truck sales. So if we look to China, we've likely seen peak oil, and oil demand likely trends lower. If we look globally, we're assuming kind of very low oil demand growth, primarily driven by kind of emerging markets and growing kind of middle classes in, across 2 billion people in, across sort of India, Bangladesh, Pakistan, Indonesia, Philippines. There's still Vietnam. There's still huge population growth and more oil usage. So that's kind of offsetting any declines elsewhere. But still, we're more cautious on oil because of the fact that OPEC are now clearly focused on regaining market share rather than protecting pricing, and that's our primary reason for concern. Now, gas actually, the energy transition will need more gas, because when you have variable renewables loading into a grid through both solar and wind power, you need to fill the gaps and stabilize that. And gas is pretty crucial to that, because there simply isn't battery technology sufficient on a large enough kind of grid scale. We have some smaller projects that are able to kind of meet a degree of demand for a space of 20 minutes or so, but there's not enough that you'd need to realistically have to cover multiple days if you're going to have a period of low wind and low sunlight, or particularly in the UK with dark winters. If you have no wind through a period of Dunkelflaut, then ultimately you'd have to have batteries that have to last weeks, arguably, and that just simply isn't going to be sustainable. So gas is going to be very key towards meeting that gap. It's going to coincide with renewables, because it's going to be required to balance. So actually, we expect to see more gas demand going forward. And then this is just being stepped up again by the big growth in AI and data centers, which there's going to be a huge energy requirement. And there's some a broad range there of expectations or predictions on what exactly that looks like. But in reality, the only near-term solution to try and meet that is either extension of existing nuclear reactors, which we're seeing in the West, but then it's going to be using gas gensets and gas generators to kind of meet that gap, to provide some degree of relatively stable base load. So we do expect to see more gas going forward, and we think in Asia we're going to continue to see more gas displacing coal, which has continued to grow in the likes of China, but we think we're probably getting somewhere near peak on coal usage, and we expect to see greater transition to gas going forward, in part for environmental reasons and also air quality. So yeah, the question there around support providers, we do like big steel. We like big steel because no one is going to build any more big rigs. They simply don't have clarity to commit to building a rig that's going to be delivered in 7 or 8 years, and then they'd have to devalue over a 50, 60-year period. So as a result, they would have to devalue it over a much shorter period, and thus the day rates required to incentivize building a new large rig wouldn't just isn't going to be isn't going to be reached. And ultimately, banks are really pulling back from lending into it, and it just makes it very difficult to build new rigs. To a lesser extent, we see that across other support services. So, you may see across some of the smaller ships or some of the service providers that tie into that. But depending exactly what support services they're talking about, I think there's, if you're looking at kind of drilling support services, for example, wirelining or aspects like that, or plugging, etc., plugging and abandonment. We think that there will be a step up in activity in gas, but maybe oil activity is going to kind of tail off slightly, but slightly dependent on whether you kind of tie into a Middle Eastern growth from OPEC or whether you're more tied into Western suppliers. Slightly long-winded, but I'll leave it there.
Perfect. Thanks for that, Rob. Oil services as a sector screens very lowly valued, but any thoughts on composition / potential skew within the sector and potential opportunities?
Yeah, I mean, we kind of covered that off a little bit there on some of the on some of the other aspects, but our preference is generally for the bigger kit, because there's a bigger barrier to entry of anyone kind of adding new supply, and that's the same across shipping. We think we can have a bit more conviction around global oil flows rather than we can around kind of more regional energy flows in sort of sub-regions, which end up becoming more nuanced, and it's not one. It's a bit more complicated on both the supply and demand side because you have so many different inputs. We have a bit more clarity around those bigger flows, and we show that through owning Transocean, which is the largest of the large rig companies, owning Frontline, which is the largest listed crude shipper through VLCCs, the largest of the crude ships, and BWLPG, which is the largest of the listed LPG players. And one thing I would flag with those is, because they're the largest doesn't mean they trade at a premium. Actually, in most cases, they trade at a discount, with Frontline being the exception, which kind of trades more to parity with the broader sector.
Thank you very much. Another question here. CGN recently moved its sales agreement framework to increase the percentage pricing exposure to the spot market. Do you see this as reactive to historic price moves or proactive to anticipated price moves?
I'm happy to dive in on that. I mean, I think that's CGN ultimately needs supply. So CGN is is China Guangdong, so the big Chinese nuclear utility, who is trying to secure supply to meet its reactors. They have done this because this is what they need to do to get sellers to commit to selling product to them. The reality is they commit to tens of billions of capex annually across their reactors, and they need supply of material to what is a very small number relative to the overall capex that goes into building these reactors. Hence, security of supply is hugely important and key. Thus, they're happy to take that pricing volatility risk. If uranium price doubles, that's really, as Keith said earlier, pretty immaterial in the overall cost, because uranium itself is a very low input proportion of the overall cost per kilowatt hour generated, with capex being the major component, which is one of the reasons why China builds far more reactors, because they're able to build them. More recently, we've seen them building at somewhere around about a fifth of what we built Hinkley for on a power output basis. So, we don't think they're too concerned around the pricing. It's purely about locking in supply.
Perfect. Moving on to the next question. Are there any opportunities in Argentina under Milei?
I'm happy to take that.
I'll try and answer that one. I'd like to think so, but at the moment we're struggling to find them. I think one of the biggest, if we look at the region, certainly the reform seems to be moving in a very positive direction. We have spoken with a few companies that still, I think, struggle to get funds in and out, which is just a little bit of a flag for us at the moment. But overall, we haven't really seen that many opportunities come our way. The one thing I would note, though, is that we do like that sort of region, because I think it's fairly agnostic in terms of, one, it's undergoing, I think, positive reform, but it's also as part of that agnostic as to taking sides in this trade war, which I think others are being forced to, and that was a region which therefore will probably have a little bit more competition for assets, as they go through, and we potentially enter a sort of an M&A cycle. So difficult one to answer that we've not found anything yet, but it's certainly an area of interest, a bit like Brazil to a degree.
Thank you for that, Keith. We've got another question here around uranium. Uranium is so volatile. Is it worthy of 11% weighting? What do you think of enrichers such as Centrus, which might be a less volatile way to play uranium?
I would say that it is volatile, but the problem is everyone looks at the spot price, and that can be volatile, but it generally represents a very small portion of the overall market supply. And the price that you really need to look at, which most suppliers of which don't really provide free access to, is the term contract, or the longer term received price that the miners will get, and that is far less volatile. I think that does filter through to some of the retail mindset, and to an extent we do see and understand why that is the case. But the point is that the longer term price still needs to move up in order to incentivize that new supply to come on stream, and we're not seeing the ability to react to it. I think Centrus, I'm trying to think if they're referring to the Centrus, which is the US company. I'd say that is particularly volatile. I'd be slightly cautious of that one, though the share price has done very well, along with many others in the sector lately. But I think the backbone of their former valuation was effectively the 10x agreement that they had, so they could take Russian uranium supply and distribute it with a quasi monopoly status into the US. So in that sense, I'd be wary. Certainly, their experience in building enrichment is checkered. That I think they previously were contracted to build one for the Department of Energy or Defense some decades ago, and it shook itself apart, so they buried it.
That's great. We actually have one final question here. Will the company's gearing change following the tender offer?
I'm happy to take that. Yeah, so no, the gearing won't change at all. Effectively, those that tender will be split into a separate pot, effectively, and everything will transfer. Everything will be equivalent. The reality is actually the gearing's pretty low here, and that would be addressed within day one anyway. So it wouldn't be running any gearing. So look, the writing's kind of been on the wall here about what a potential outcome was going to be. So that's allowed Keith and I to kind of be active ahead of this and ensure that we're kind of managing any kind of less liquid positions. So we kind of feel, or certainly on the listed side. So that certainly makes that certainly means that we're coming into this kind of feeling reasonably comfortable about how that will work operationally. So yeah, gearing won't change. There won't be any change. It'll just be an exact split on a per share basis. So no one will be disadvantaged. Ultimately, just those that tender end up going into that pot and wearing all of those tender costs within that pot.
Perfect. Well, Keith, Robert, you have been very generous with your time. We've got through a lot of questions and covered a lot of ground there. So just before wrapping up, Rob, if I could just ask you for a few closing comments, that'd be great.
Look, I just kind of want to highlight that yes, there is a bit of uncertainty around this tender going on for shareholders, but we're very constructive on the outlook. We think the fund's very well positioned to benefit from the sectors that it's in. Shareholders themselves aren't going to be disadvantaged. The fee is coming down. The dividend is going to be preferential to many shareholders, and we may even see a situation where that leads to some incremental buying. keeps that discount low, potentially even gets to a premium, and really could help us kind of drive forward and see the fund grow. Because we really believe in the underlying sector. We think the fund itself is unique in being able to allocate very actively, and we think that as a service to investors is, providing that years of expertise. I've done this 20 years, Keith's done it over 30 years. I'm a geologist, and we think that's something that does add value to shareholders. So thank you for your time, and thank you even more so if you've hung around over an hour.
Perfect. Well, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. On behalf of the management team of CQS Natural Resources Growth and Income PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.